Introduction. Investing in mutual funds can be a rewarding way to grow your wealth over time. With a wide range of options available in the Indian market, selecting the right mutual fund requires careful consideration and research. In this guide, we will walk you through the essential steps to choose a mutual fund that aligns with your financial goals and risk tolerance. 1. Understand your financial goals. Before diving into the world of mutual funds, it's crucial to have a clear understanding of your financial objectives. Are you investing for short-term goals like a vacation? Or are you aiming for long-term wealth accumulation? Identifying your goals will help you determine the investment horizon and the level of risk you can afford to take. 2. Assess your risk tolerance. Risk tolerance varies from person to person. Some investors are comfortable with higher risks for potentially higher returns, while others prefer a more conservative approach. Evaluate your risk tolerance honestly, as it will influence the type of mutual funds you should consider. 3. Choose the right mutual fund category. Mutual funds in India are categorized based on their investment objectives. Common categories include equity funds, debt funds, hybrid funds, and more. Equity funds have the potential for higher returns but come with greater risk. Debt funds offer more stability but generally have lower returns. Consider your goals and risk tolerance to select the appropriate category. 4. Analyze past performance. While past performance is not a guarantee of future results, analyzing a mutual fund's historical performance can provide valuable insights. Look for funds that have consistently outperformed their benchmarks over various market cycles. Keep in mind that consistency is key, and avoid chasing short-term performance. 5. Expense ratio matters. The expense ratio is the annual fee charged by the mutual fund for managing your money. A lower expense ratio can significantly impact your overall returns, especially over the long term. Compare expense ratios among funds in the same category to make an informed choice. 6. Fund manager expertise. A skilled and experienced fund manager can make a significant difference in the fund's performance. Research the fund manager's track record and investment philosophy. A manager with a consistent and disciplined approach is more likely to deliver sustainable returns. 7. Diversification and portfolio composition. Diversification reduces risk by spreading your investments across different asset classes and securities. A well-diversified mutual fund portfolio is less susceptible to the fluctuations of a single investment. Review the fund's portfolio composition to ensure it aligns with your diversification goals. 8. Check for consistency in fund house policies. Different mutual fund houses have varying investment philosophies and approaches. Ensure that the fund house's policies align with your investment objectives and risk tolerance. Consistency in the fund house's approach can contribute to stable performance. 9. Tax implications. Mutual funds in India have tax implications based on factors such as fund type, investment duration, and capital gains. Understand the tax implications of the mutual fund you're considering and how they align with your overall tax planning. 10. Seek professional advice. If you're unsure about making investment decisions on your own, consider seeking advice from a certified financial advisor. A professional can provide personalized guidance based on your individual circumstances.